Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. And here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. There had been two main drivers here since late spring and throughout the summer, as well as going into autumn. First was an obvious April to August bearish shift pitchfork, which has since been broken and retired. The second driver is still live and was the construction of the June to date double bottom. It is a lopsided double bottom, but is nevertheless still there. The market is currently scaling upwards on the second part of this double bottom. Prices are now very close to confirming it as a pattern. You would need at the very least prices to exceed, and properly exceed, the 50% Fibonacci line of the June to October 2018 move at 22.21. As I said, we are very, very close now. This brings me to a newer piece of action that was formed during September today, and that is a bullish halfway hesitation. During this past week, the market reached and exceeded some crucial stages in the construction of the second up leg. Prices punched through and closed over the highs in October between 2048 and 2094. The flatlining long moving average, currently 21.22 as well. This last one had capped the market effectively back in August, and it deserved consideration. However, the market overcame both these significant resistances and reached target X for a bullish halfway hesitation in the 2160 area, right where the lower trendline extension to the May to June 2021 descending triangle is situated, and just above the 50% Fibonacci line of the March 2020 to March 22 move at 2135. Prices have indeed exceeded target X and are currently up testing the 50% Fibonacci line of the June to October 2018 move at 22.21. Beyond this, well, we have the congestion from earlier this year between about the 50% Fibonacci line and about the 2450 area, within which sits the very interesting 50% Fibonacci line, the big old 2010 to 2011 move at 2378. Two final things to point out. I've drawn a fresh late September to late October bullish Andrews pitchfork. This is a very steep looking one, so its lifetime may be limited, but for now it works, and the market is just under the middle time, currently at 2257. Secondly, and I think this is the most important thing of all, none of this current rise would have been so good and so clean without the aid of one specific candlestick pattern. Monday last week, the market made a combined immediate countering key reversal up, bullish closing long white Mariposa, and bullish belt hold pattern. It is the last of these three excellent patterns, the bullish belt hold, that I wish to highlight. Belt hold patterns are relatively rare, and when they happen, you pay close attention to them, as they seem to be by a country mile one of the most potent bearish, or as in this case, bullish patterns out there. And I think I'll leave you with just those thoughts in your mind. LME 3-month tin. The story since late June has been a series of stratified support levels. The major ones overhead that saw the market push down through them, and our active resistance are at the following levels between 23,000 to 24,155, the 21,360 area, the 2430 to 2510. More recently, the following levels have now acted as support. Then in October, the market broke down through these levels before turning back up again and recovering and becoming support again. These are at 19,270, 18,810, 18,590 and 17,525. The descent ceased 2 weeks ago and the market has turned higher, prompted by congestion at 17,525 and just ahead of the September 2020 low at 16,970. This pullback overcame some, to be honest, lightweight resistance, but then tackled and punched up through the now flatlining short medium moving average, currently at 20,125. Today, prices have punched through the next significant resistance, the slowly declining medium moving average, currently at 22,275, and have moved up into a banded area of resistance previously mentioned between 23,000 to 24,155. For a first effort today, it has managed to plough quite a path through this congestion. We now have a more immediate band overhead dating from June to the end of August between approximately 24,000 to 25,520. It is a separate band, but I suppose it's connected to the earlier band. The action since late August has caused me to think that perhaps the action is a possible descending scallop pattern. I would like to see more on this to be sure, but right now it looks a lot like that to me. I'm minded therefore to give just a provisional idea of on the upside for such a pattern, assuming of course it does not peak and revert back down, which would also be in line with this pattern's formation. But for a continued move higher, you would have to look primarily in the 25035 area, and possibly later on, should it continue, up to the 27475 area. I'm not ready as yet to start naming targets on the top side for this pattern, but it is worthwhile being prepared just in case, as I can easily discard these if they prove unsuitable. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.